Hello, everybody. Welcome to this week's edition of Market Insights. Hope everybody had a great weekend. I know that I did. Fantabulous. My name is Steven Sitkowski. In case any of you don't, half the time I don't even think about giving my, in my mind, I'm famous. No, I'm just messing with you. I'm barely known by the people that live, on my block. Anyway, everything we do here is for educational and informational purposes, and apparently for my own amusement. Um, None of it should be misconstrued as investment advice. Talk about what's moving the markets. Big earnings week ahead. This is the biggest earnings week of this season. So if we don't get any more tariff news, or we don't have any news bombs dropped on us, not bombs, um, then this week should go the way that earnings go. So we got a number of big names that'll be announcing. And, in normalized markets, earnings are everything. They're called the mother's milk of the stock market. When they're up, earnings go down, stocks go down, that kind of a deal. But of course, news-driven market, primarily focused around tariffs and trade wars and the talk of recession, as opposed to getting back to the business of earnings. So happily, I think this week it'll be all about earnings, which is what the market should be about. U.S. is in trade conversations with both China and India. I think the Chinese deal will take a while. They are going to be a little more stubborn as the U.S. Seems like India is more interested in making a deal, but if we could just get one or two major deals put together, it would be such an incredible stimulus for this market. So fingers crossed. You want to know what could cause the market to go back to its former highs? I just gave it to you. A couple of trade deals. We'll see. Inflation and employment data due out this week. I'll go through some of the economic data that will. So that could also have a definite impact on market direction for the week. 10-year Treasury is sitting at a very attractive number as it relates to equities. I think anything under 4.5 is great for the stock market. Under 4, it's fabulous. Right now we're at 4.268. And oil prices have dipped just a tad to 62.48. I still think the oil patch is a decent place for equity investors to put out. Prices are pretty benign right now. Market breadth last week, very encouraging. 65 new highs, 128 new lows. But you see the advancers versus decliners, 2,261 versus 561. So on the new highs and new lows, that's not good news, but the advanced decline are certainly encouraging. And same thing on the NASDAQ, 3667 higher, 990 lower. It's great. What to watch this week? What are the big news announcements coming out? Nothing today. Tomorrow we get the consumer confidence number coming out. That's expected to fall some. People are just generally nervous. And I don't blame them, a little shell-shocked about what's going on. Job openings are coming out. They're supposed to fall by 200,000 from previous month. Then we get our ADP employment number, expecting 110,000 new jobs. Last month it was 155, so there's a fall. GDP comes out, annualized growth of 0.4%, which is pretty meager. but it's a positive number. Personal income will be coming out, and the all-important PCE, personal consumption expenditure, which is the Fed's preferred inflation number. So they're expecting year over year 2.2, down from 2.5. The market would definitely welcome that, and core inflation down to 2.5 from 2.8. We're getting near that 2% level, which would give the Fed some room to start cutting. Thursday, we get the manufacturing PMI number, as well as the ISM manufacturing number. Let us know how the economy is doing. Get the unemployment rate. It should hold steady at 4.2%. So there's just a ton of data coming out. One of the busiest news weeks that we have seen in a while. So that'll be fun to watch. Last week's heat map, whole lot of green. Beautiful thing. So we had, I think, a 4-day winning streak last week. We haven't had many of those in 2025, so it was welcome. That was all on the heels of that 90-day moratorium on tariffs. Year-to-date returns, not great. Tesla down 27%, Nvidia down 18%. So, the Magnificent Seven have been anything but magnificent this year. Where's the money been made? Consumer staples. Look at Philip Morris up 41%. Last week's big winner. So we started seeing some comebacks. ServiceNow up 22%, Microchip Technology 21%, Palantir made a big move, Tesla had a great week, Micron Technologies, Supermicro. So there are a number of companies that did well. This was pretty encouraging, and I think it was a result of the fact that a lot of stocks are beaten down. On stocks that beat their earnings estimate, they went up 2.4%. On stocks that missed, they only went down 1.9%. And it's been the reverse. It's been stocks that beat barely go up. Stocks that disappoint on earnings got crushed. That's not been what's happening this season. By the way, 73% of companies reporting have beaten their estimates. Look at those earnings announcements. I mean, just, Waste Management, that is today. Tomorrow, we've got Pfizer, Coke, SoFi, Starbucks, Visa. On the 30th, Caterpillar, GE. I mean, lots of the biggies. Meta, Microsoft. This, my friends, is what's going to move the market. Thursday, MasterCard, Eli Lilly will be announcing, Apple. And then on Friday, you've got Chevron will be announcing, Shell. So a diversified group in terms of, asset or sector classes. Market sentiment still sucks. Only 21.9% of independent investors think the market's going to go higher over the next 6 months. I'm telling you, these 55% that think it's going to go lower, they're going to be wrong. Mark my words. We are still scheduled right now for 4 rate cuts for the balance of this year. 4 rate cuts and no recession means market is going to move higher. Sector returns. So right now we're only down year to date 5.87%. I've had a lot of people tell me I'm down way more than that. Well, what does that tell you about your approach? You got to refine that a bit. So we now have 1, 2, 3, 4 sectors of the 11 that are higher. REITs are down less than 1%. Really, the only 2 problematic sectors, technology and discretionary. Thought you might find this interesting. Who owns the stock market? It is 38% owned by people like you and me. 6% passive mutual funds, 9% ETFs, 11% active mutual funds, pension funds 10%, foreign investment 18%, hedge funds 2, business holdings 4, and other, whatever that is, aliens, creatures from outer space own 2%. So 38% owned by people like you and I. Now, the problem is the top 10% of the economic bracket owns 88% of the stocks. All right, let's take a look at the charts. See how things are shaping up on the S&P 500. So, you can clearly see we're making another run to get back to that 50-day moving average. We are certainly headed in the right direction after last week. We haven't crossed yet. Market opened up this morning, and as of this recording, was down a little bit. But, there's two things we need to see. And this all depend on, combination of earnings and any news that comes out of the White House. We need to see a cross above that 50-day, and then we need to see that 50-day start to flatten out. Right now, it is still sloping down before we feel like the coast is clear. The MACD looks great. RSI looks great. OBV, that's on balance. Volume looks great. So we definitely have some positive momentum. But I'll also tell you, traditional technical analysis in this market doesn't work. It just doesn't. This is all about the news. So we'll continue to follow that for you week by week. And I'll give you a report, let you know what we see. All right. Have a fantastic week, and I'll be talking to you soon.